Welcome back. Take a look at futures this morning, showing a gain at the start of trading this morning, indicating we will have a firmer start. Dow Industrial's up 65. The Nasdaq's now positive by 3. The S&P higher by 7. Yields are also higher this morning, but perhaps off of, no, we're at the highs of the morning on yields as well. The 10-year Treasury up almost 7 basis points right now to a level of 4.554%. Federal Reserve Chairman Jay Powell yesterday urged economists to remain flexible. Think outside traditional economic models, he said, as you offer your projections. Meanwhile, Chicago Federal Reserve President Austin Goolsbee told the Journal that the Fed will need to pay close attention to the effects of higher long-term bond yields to make sure they don't slow the economy more than expected over the coming year. Joining us right now is Piper Sandler's managing director and senior economist, Jake Oubina. Jake, great to see you.
Good to see you, Maria.
Thank you so much for being here. Assess where we are. You just heard what Austin Goolsbee said, and you see where yields are. What are you expecting from the macro story going into year end?
Yeah, look, I think what Powell said makes a lot of sense. You can't use traditional models. One of the things that the Fed's struggled with, I think, over the course of the last year and a half, 2 years, is the fact that they've been pushing against this massive wall of fiscal cash that was added to the economy over the course of the pandemic. Households really started to spend that down over the course of 2022 and into 2023. And so you're raising rates into this wall of cash that continues to support the economy. How do you know you're being effective from a monetary policy standpoint? We're now moving beyond that wall of cash. Excess savings has come all the way back down for the lower 80% of income groups. Those are the groups that really drive spending vis-a-vis savings. The top 20% really doesn't spend from savings. And so we've lapped that. We've now increased tightening of lending standards in a significant way over the course of the last year. That always acts with a lag in terms of throttling down credit growth, throttling down consumer spending growth. And so I think the Fed is now looking at all these things, and they've got a setting at the policy rate that's 5.5% at the top end.
Yeah.
That might be way too high once we move past all of these things that have artificially supported the economy over the course of the last year.
We were talking in the commercial break, all of us, and you said unemployment is the most important thing to focus on right now.
Yeah, I think we're transitioning from this mantra of inflation and a complete unique focus on inflation over the course of the last few years to unemployment. And I think, the things that have happened on the unemployment side over the course of the last 6 months in particular tell us that we're moving into the late cycle stage. By the way, this is completely consistent with the historical precedent, right? So what's the first thing to inflect after the Fed starts tightening? Corporate revenue. Corporate revenue in real terms went flat in the first half of this year. And then it's employment, because you're responding to that margin pressure. You're responding to that demand falling off, that productivity coming down. We're starting to see that play out. The level of unemployment over the course of the last 6 months is up 15%. We've never had that type of change without a lead into recession. And so I think what we're doing is we're morphing from phase 1 of the unemployment rate increase, which is this gradual move higher off the lows, to phase 2, where you start to see more precipitous increases. And I think the recent data are dovetailing with that. Look at the Warren notices, these notices that companies have to give to states when they're going to do mass layoffs, leads by 60 days in terms of the unemployment stuff. That really, it went very high in August. It just got revised up for September. We've seen material increase in layoff announcements over the course of the last year. We've seen much lower retail hiring this year than last year, which was already a very weak year, right? So I think you have a lot of pieces in place that are telling you that we're into the late cycle, early recession phase of the unemployment rate backdrop.
That means the Fed, though, Maria, is doing its job. If you think about it, that's their whole point, right? Is
slow things down.
Yeah, slow things down. Well, then you're saying that that's working. And the bigger, question when it comes to employment is, obviously, it sounds to me like you're saying the market's completely getting it wrong when it comes to the jobs data. So how should we be reading these employment reports? I'm sorry, how should I be reading this employment report? Let's be specific here.
Yeah. So I think one of the things that's masking some of the weakness is this birth death adjustment that the BLS goes through every month. They try to account for how many businesses were created in the U.S. versus destroyed. They're taking a sample, so they have to make an adjustment for the population. That added 400K plus NSA last month. Seasonally adjusted, it's still added about 125,000. It's the number one reason you get downward revisions in hindsight to the payroll numbers. The payroll numbers aren't telling you anything about where you are from a cycle stage standpoint because they have all these artificial add-ins, right? You strip all that out and you strip out the non-cyclical sectors, employment growth's basically ground to a halt over the course of the last 3 months.
I'm surprised. I didn't realize unemployment was up 15%. Did you know that, Mark?
Yes, we've gone from 3.4 all the way up to 3.9 now over the course of the last 3 to 6 months. So that's a pretty substantial move, But when we talk about just I guess the smoke and mirror headline jobs numbers, according to the Biden administration, we've added 1.234 million jobs since April of this year. However, when you look at the actual employed workforce, we only have another 190 people actually working over the course of that entire time frame. We are losing full-time jobs. We're picking up part-time jobs, multiple job holders at an all-time high. So it doesn't look good when you look at the composition.
Yeah, and look, I think we rely way too much on the payroll survey. Again, it's subject to significant downward revisions. You look at the household survey, it doesn't go through that process. It's slowed in a much more meaningful way.
I'm so glad you mentioned that. That's what we were pointing out last week, the household survey.
Yeah, and you look at the employment numbers in the productivity report, which are much more encompassing. They don't get a lot of attention. But why has productivity gone up in the second quarter and the third quarter? They actually built in flat for employment in the second quarter and a marginal increase in the third quarter. So again, these numbers that don't go through these machinations in terms of trying to adjust for whether we have more or less businesses in the country are showing a much flatter trajectory for unemployment.
Real quick, we got to jump, but next week CPI. Any thoughts?
We're light on the headline. Energy is going to be a big drag. I think we're going to come in at about a tenth for headline. Core, we see it at 0.2. This cadence in shelter continues. Used cars still soft. And so I think it's going to be another relatively benign one.